Most people missed what happened this week. While the headlines were dominated by tech stocks and political noise, a far more significant signal was flashing in the background. It is a signal that usually precedes a structural shift in the global financial system, yet it is being largely ignored by the mainstream financial media. When you look at the raw data, specifically regarding the price action of silver over the last 12 months, you start to see a picture that does not align with the narrative of a robust, stable economy. We are seeing numbers that would typically trigger breaking news coverage. Silver prices have moved aggressively, up more than 200% in a specific time frame depending on how you measure the bottom, significantly outperforming traditional safe havens and risk assets alike. If you had allocated capital to this sector a year ago, the return would be staggering. But this is not about the profits. Focusing on the percentage gain is a distraction. The real story isn't that silver is going up. The real story is what silver is rising against. This isn't panic buying from the retail public yet. This is a pattern of institutional repositioning that suggests the smart money is quietly heading for the exits of the traditional fiat system. This wasn't supposed to happen like this. According to standard economic theory, when interest rates are high and the dollar is relatively strong, non-yielding assets like precious metals should be under heavy pressure. They should be falling. Instead, they are climbing a wall of worry. This divergence is the most important chart in finance right now because it tells us that the old correlations are breaking down. The market is beginning to sniff out a problem that the central banks are trying desperately to conceal. To understand why this is happening, we have to look at the macro environment with cold objectivity. We are currently operating in a period of unprecedented liquidity pressure. The United States is managing a debt load that has mathematically moved beyond the point of repayment in real terms. The interest expense on national debt is now rivaling the defense budget. For decades, the assumption was that treasury bonds were the risk-free asset that anchored the entire global financial system. But when the issuance of that debt accelerates exponentially, the market begins to question the value of the currency denominating that debt. Institutions are seeing this. They are looking at the yield curve, they are looking at the commercial real estate maturity walls, and they are looking at the balance sheets of regional banks. They know that the only way the system stays solvent is through eventual liquidity injections, what we used to call printing money. The market is forward-looking. It doesn't wait for the official announcement of quantitative easing. It moves in anticipation. The rise in silver we have witnessed over the past year is essentially a vote of no confidence in the long-term purchasing power of the dollar and the stability of the banking sector. There is a palpable tension building beneath the surface of the banking system. We saw the cracks form last year, and while the emergency measures patched the holes, the structural imbalances remain. Banks are holding assets that have depreciated significantly in value due to higher rates. If they were forced to mark those assets to market today, the insolvency issue would be front and center. This creates a highly fragile environment where trust between institutions begins to erode. In that environment, counterparty risk becomes the primary concern for any capital manager. Silver, unlike a bond or a currency deposit, has no counterparty risk. It is an asset that stands outside the financial system. When you see a 200% move in a year, you are watching capital flee from counterparty risk. It is a defensive move disguised as a bull market. The smart money isn't necessarily betting on silver. They are betting against the sustainability of the current debt paradigm. They are moving capital into hard assets because they anticipate that the rules of the game are about to change. We need to discuss the specific pressure points creating this dynamic. One of the most critical factors is the physical tightness in the market. For years, the paper market, the futures contracts traded on the COMEX, dictated the price of silver. Huge amounts of paper silver are traded daily, vastly exceeding the amount of physical metal that actually exists. This allowed for price discovery to be detached from physical reality. However, we are seeing signs that this mechanism is stressing. The demand for physical metal, particularly from industrial sectors and Eastern central banks, is draining the vaults. When the physical inventory gets low enough, the paper price loses its leverage. We are seeing a slow motion run on the physical inventory. Solar panel production, electronics, and green energy initiatives are consuming silver at a rate that mining supply simply cannot match. This structural deficit has existed for some time, but it was masked by above-ground stockpiles. Those stockpiles are dwindling. When you combine an industrial supply crunch with renewed monetary demand, you get the kind of explosive price action we have seen recently. The reaction of the average investor to this news is usually to chase the price, hoping for a quick profit. That is a mistake. The professional approach is to analyze what this price movement signals for your broader portfolio. If silver is repricing, it means the market is pricing in higher inflation for longer. It means the market believes the Federal Reserve will be forced to pivot to lower rates, or to introduce yield curve control to save the treasury market. If that happens, the dollar weakens, and real assets revalue higher. This is where the distinction between paper gains and purchasing power becomes critical. If silver goes up 200%, but the cost of living rises by 20%, and the purchasing power of your cash drops, you haven't necessarily gotten richer. You have simply preserved your wealth while others lost theirs. That is the function of gold and silver in a portfolio. They are insurance, not lottery tickets. The recent performance is a payout on that insurance policy, signaling that the fire is getting closer to the house. It is also important to address the suppression narratives that often circulate in this space. It is true that massive short positions exist, often held by large bullion banks. However, viewing this solely as a conspiracy misses the larger mechanical point. These banks trade spreads, they manage books. When the physical market overwhelms the paper market, even the largest banks cannot hold back the tide. We are seeing a capitulation of the short side. The cost to maintain those short positions in a rising market becomes prohibitive. This creates a feedback loop, a short squeeze, that can drive prices significantly higher than fundamentals alone would dictate. We have seen this pattern before. If we look back at the 1970s, there were periods where the stock market went nowhere in real terms, while gold and silver staged massive rallies. The drivers then were similar: high deficits, loss of confidence in the currency, and geopolitical instability. The difference today is the sheer scale of the debt. The numbers are vastly larger, the leverage in the system is higher. This suggests that the volatility we are about to experience could be more severe than what we saw in the past. The psychology of the market is shifting. For a long time, the belief was that the central banks had everything under control. The Great Moderation led people to believe that crises could be managed without consequence. The price action in silver over the last year suggests that confidence is breaking. When an asset that has been dormant or suppressed suddenly wakes up and delivers triple-digit returns, it catches attention. It forces fund managers to ask why they have zero exposure to this asset class. As institutional funds begin to allocate even a fraction of a percent of their capital into precious metals, the buying pressure on a relatively small market like silver becomes immense. We must also consider the geopolitical dimension. Central banks in the East are buying gold at a record pace. They are diversifying away from the dollar. Silver often moves in sympathy with gold, but with higher beta, meaning it moves faster and further. As the world bifurcates into competing economic blocks, the demand for a neutral reserve asset increases. Silver has a dual role here. It is both a monetary metal and a strategic industrial commodity. In a world of supply chain fragmentation, securing physical silver becomes a matter of national security for industrial nations. Corrections will happen. The price will not move in a straight line. In fact, sharp pullbacks are often engineered to shake out the weak hands, the retail speculators who bought late using leverage. But the underlying trend is driven by fundamentals that are not changing anytime soon. The debt is not going away. The industrial demand is not disappearing. The geopolitical tension is not resolving.